Welcome to another version of Eastern Europe, Economic and Financial Environment, Video 2 from Team 3. And once again, back for this version of Eastern Europe, our international correspondents, Jessica, Mary, Mike, Lydia, and Tricia. And today we'll be covering current economic state, details, insight, and business market implications, as well as financial overview, currency, exchange rates, markets, and U.S. corporate marketing implications. We begin with the Czech Republic. The Czech produced $216 billion in GDP in 2017 and is forecasted for $265 billion in 2019, making them the 47th largest economy in the world. That's underscored by GDP growth of 2.9% and inflation kept in check at 2.3%. A couple of key highlights: Q1 growth is very healthy with household spending strengthening. Confidence in the industrial sector is slipping a bit, but growth should remain solid overall. Weakening EU demand has put some risk out there, but analysts expect growth to be 2.6% in 2019 and 2.5% the year thereafter. GDP per capita continues to increase for the Czech Republic, coming in close to $35,000. And as far as which sectors are driving agriculture, industrial services, it appears for the last 10 years, those all seem to be stable. No real moves either way. Their Gini score, however, is a pretty good score at 25.9 with a fairly good equality in country. And their drivers for growth in the economy are auto production, steel production, and heavy machinery. Some of the related economic significance born out of these insights are the economy is thriving. The growth acceleration in 2017 was 4.6%. That's been driven by strong household consumption and support from income growth. Exports also sustained nice expansion in 2017, and unemployment rate has continued to decrease throughout that same period of time, down below 3%, one of the lowest in the OECD. With additional insight in the financial environment, the currency is the korun. Also utilized is the euro. When it comes to creditworthiness, the Czech Republic does well, offering a yield of only 1.5% with little need to borrow. In addition to that, look at the PX, their stock market, continues to grow into 2019. With a nice strong performance the 2 years prior. Also reflected in that is the currency exchange with the US dollar, where current rates are about 22.65 per dollar. And to wrap up the Czech Republic, they are an innovation-driven economy and very receptive to U.S. technology products, as well as an increasing investment from the U.S. So therefore, they are very acceptable and welcoming of American business. Our next stop is Hungary. GDP in 2017 was $139 billion and projected to be $165 billion in 2019, making them the 57th largest economy in the world. Underscoring that is 3.6% real GDP growth and inflation kept in check at 3.2%. Couple highlights: economic growth is at a near 2-decade high as of Q1 2019. Export growth picked up faster than expected, although there's a little short-term growth prospect issue with the EU and caps that may come in place. Analysts believe they predict economic growth to be about 3.9% in 2019 and 2.8% in 2020. GDP per capita continues to rise to nearly $30,000 per person. And as far as industry, agricultural services, although those all seem in line with no real change over the last 10 years, their Gini score, a fairly healthy score at 30.9, and their key drivers are steel production, construction materials, and mining. Key economic highlights are growth at 4.5% in 2018, strong private consumption, real income gains. Also notable is the unemployment rate has fallen, and there has been a broad-based wage increase helping to propel the economy. The currency for Hungary is the forint. However, the euro is accepted in limited locations. The creditworthiness is fairly good for Hungary, coming in at 3% yield on their 10-year bond. Their stock market has done well. The BUX, as of 2015, continues to climb, although you have seen some depreciation of their currency versus the dollar. More recently, they're at 286 forint per dollar. The financial environment or market opportunity is fairly good in Hungary. There are 400 wholly owned U.S. companies in the country, which employ about 100,000 Hungarians, making the U.S. the second largest investor in the country. On to Romania. Romania produced $212 billion in GDP in 2017. Is projected at $249 billion for 2019, making them the 49th largest economy in the world. And GDP growth has been pretty good over time at 3.1% with an inflation rate of 3.3. A couple of highlights here. The economy grew at 5% versus last year. Very healthy growth in Q1 2019. And however, there's weakening demand from the Eurozone, which is stifling some industrial output, as well as fiscal and current account deficits that remain a concern. However, analysts see growth at 3.5% in 2019 and 3% the year following. Romania does continue to see improving per capita purchasing power as they move to close to $25,000 per capita in 2017. That in light of some also movement in the service sector in 2017, where that sector continues to outpace the agricultural and industrial sectors within the country. Their Gini score comes in at 27.5, which isn't all that bad considering. And their drivers in the economy are electrical machinery, textiles, and footwear. A couple of economic notes here. The average applied tariff rate is 2%, and the regulatory system in Romania tends to discourage foreign investment. The currency in Romania is the leu, but also accepted is the euro. As far as the 10-year bond yield, that's showing 4.5%, which is not a good indication in terms of its credit worthiness. They're having to offer more yield. As far as the stock market, the BET, that has seen a nice appreciation all the way back since 2012. More recently, you've seen the dollar gain against the Romanian currency coming in close to 4.2 leu for every dollar. In all honesty, not a lot of noteworthy opportunity in Romania, but they are working towards a stronger economy and outlook for their future. Now for a look at Russia. GDP for Russia in 2017 was almost 1.6 trillion, and nearly that in 2019 as far as projection at 1.65 trillion, making them the 12th largest economy. Underscoring that is the only 1.6% GDP growth and a rather large inflation rate coming in at 5%. A couple of highlights here. Growth plunged in Q1 2019. One of the worst readings since the economic downturn in early 2015 and 16. Seems to be slowing notably due to dampened household spending and limited oil exports. Although the government is spending on national projects, analysts see GDP growth at 1.4 in 2019 and only 1.8 in 2020. GDP per capita is fairly stagnant, around 28,000 US dollars per capita. The industries seem to be fairly steady across the board for the last 10 years. You don't see any significant movement there. Their Gini score is not so healthy compared to every other one else at 37.7. And their key drivers for industry are stuck with oil, coal, and gas. Key highlights here is the need to expand beyond the energy market, and Russia is also known to use any tactic necessary to fulfill their agenda, making them a high-risk country for development. Although the ruble is the currency for Russia, more often it's best to use the US dollar or the euro when visiting country. Their 10-year bond yield is 0%, believe it or not. Not much need to borrow money. They do run a nice trade surplus. Their market, the MOEX, has continued to appreciate over time. And the ruble has been fairly consistent against the dollar, coming in just shy of 65 ruble per dollar. Tough business climate in Russia due to US and European economic sanctions, which went in place in 2014. Russia has pushed back a little bit with some of their own counter sanctions and protectionism. U.S. companies do see there to be some advantage longer term with regards to investment in Russia, but are taking a very cautious approach due to the degree of risk at this time.